You were promised a simple deal: work hard, get educated, buy a home, live a little better than your parents did. That deal is quietly being canceled. Not announced, not debated, just erased. The middle class isn't shrinking because people are lazy or bad with money. It's disappearing because the system no longer needs it the way it used to, and that's the part no one likes to say out loud. Right now matters because this isn't a slow, abstract trend anymore. It's showing up in rent checks, grocery bills, job titles, and credit card balances. People who did everything right are falling behind anyway, not overnight, but month by month. To understand why, you have to forget the motivational posters and look at how the machine actually works. Let's start with what the middle class really was. It wasn't just an income range, it was a role. After World War II, advanced economies needed something very specific. Millions of stable workers earning enough to buy the things they produced. Factories needed consumers. Governments needed taxpayers. Banks needed borrowers who could reliably pay back loans. So wages rose with productivity. Jobs came with benefits. Housing was built for ownership, not speculation. The middle class wasn't charity, it was infrastructure. Then, slowly, the incentives changed. Technology made labor cheaper and easier to replace. Globalization made workers compete across borders. Finance discovered it could make more money moving capital than building things, and the system adapted. Companies stopped asking, how do we grow together? They started asking, how do we cut costs without breaking demand completely? That distinction matters because here's the uncomfortable math. If productivity goes up but wages don't, the difference doesn't disappear. It flows somewhere else, into profits, into asset prices, into executive compensation, into shareholders' portfolios. For decades, workers were told, be patient, growth will trickle down. It didn't. Instead, the cost of living quietly decoupled from income. Housing didn't get expensive because homes became magical. They got expensive because homes turned into financial assets. When interest rates fell, borrowing got cheaper. Cheap borrowing pushed prices up. Higher prices attracted investors. Investors outbid families. Families rented from investors. Same house, different owner. Higher payment. Education followed the same path. College stopped being primarily about skill building and became a gatekeeping system financed by debt. Students didn't just learn, they borrowed future income to access jobs that now barely cover today's costs. Healthcare, priced like a luxury, paid for like a necessity. None of this is accidental. It's a system optimized for balance sheets, not balance. Now add debt to the picture. Debt used to help the middle class move forward. Mortgages built equity, student loans boosted lifetime earnings, credit smoothed temporary gaps. Today, debt mostly fills permanent holes. Wages stagnate, expenses rise. Debt becomes survival, not leverage. And here's the irony. The economy still depends on middle-class consumption, but it no longer wants to pay middle-class wages. So it uses credit as a substitute. Buy now, pay later, forever, if needed. From the outside, it looks like growth. Inside, it's fragility. Now let's talk about work. Jobs didn't just disappear. They split. At the top, you have highly paid, highly specialized roles tied to capital, technology, or control. At the bottom, you have low-paid service work that can't be automated yet. The middle hollowed out. The jobs that once supported stable lives were either automated, outsourced, or reclassified as flexible. Flexible sounds nice, until flexibility applies only to income, not bills. Benefits vanished. Job security vanished. Predictability vanished. But the expectations didn't. You're still expected to own a home, still expected to save for retirement, still expected to absorb risk that institutions used to carry. Speaking of retirement, pensions were replaced with personal investment accounts. Risk moved from companies to individuals, from balance sheets to kitchen tables. If markets do well, you're told it's because you were smart. If markets crash, you're told that's just how it goes. Personal responsibility became a convenient story for systemic exposure. And while all this happened, asset owners quietly pulled ahead. Stocks rise faster than wages. Real estate appreciates faster than savings. Those who already own assets benefit from inflation. Those who live on income get squeezed by it. Inflation isn't just higher prices. It's a transfer from cash to assets, from labor to capital. That's why two people can live in the same city, see the same economy, and experience completely different realities. One feels richer every year without working harder. The other works harder and feels poorer anyway. Publicly, the story sounds optimistic. Unemployment is low, markets are strong, innovation is everywhere. Privately, households are fragile. A missed paycheck becomes a crisis. A medical bill becomes debt. A rent increase becomes relocation. The middle class didn't collapse. It thinned, stretched between rising costs and flat pay, held together by credit and hope. And hope, unfortunately, doesn't compound. Zoom out far enough and the long-term risks become clear. A society without a strong middle class doesn't just become unequal. It becomes unstable. Consumption weakens. Trust erodes. Politics polarize. When most people feel like the game is rigged, they stop caring about the rules. History is very consistent on this point, but here's the most unsettling part. The system can continue like this for a long time, as long as people can borrow, as long as assets keep rising, as long as the pressure breaks individuals, not institutions. The disappearance of the middle class isn't loud. It's quiet, administrative, spreadsheet-driven. It happens when stability becomes optional, when security becomes a personal problem, when doing fine means one emergency away from not being fine at all. So the question isn't whether the middle class is disappearing. It's this: if the economy no longer rewards stability and no longer protects risk and no longer shares growth, what replaces the middle class? And who exactly is that replacement for?